What if one decision made in Washington could affect your mortgage, your credit card bill, your investments, and even your job? That's exactly why millions of Americans are asking one question right now. Will the Federal Reserve cut interest rates? In the next few minutes, I'll explain what a rate cut means, why it matters, and how it could impact your wallet. The Federal Reserve, often called the Fed, is the central bank of the United States. One of its biggest responsibilities is controlling inflation while keeping the economy healthy. When inflation is too high, the Fed usually raises interest rates to slow down spending. When the economy starts weakening, the Fed may lower interest rates to encourage borrowing and spending again. Over the past year, inflation has cooled compared to its previous highs. At the same time, many businesses and consumers have been feeling the pressure of higher borrowing costs. Expensive mortgages, costly car loans, and higher credit card interest have made it harder for many families. If inflation continues moving closer to the Fed's target, policymakers could decide it's the right time to begin lowering interest rates. But nothing is guaranteed. The Fed carefully studies inflation, employment, wage growth, and overall economic conditions before making any decision. If the Fed cuts rates, here's what could happen. First, borrowing could become cheaper. Mortgage rates, auto loans, and some personal loans may gradually decline, making financing more affordable. Second, the stock market may benefit. Lower interest rates often encourage investors to buy stocks because companies can borrow money more cheaply and potentially grow faster. Third, savings accounts could earn less. Banks often reduce the interest they pay on savings accounts when rates fall. Finally, businesses may hire more workers. Lower borrowing costs can encourage companies to expand, invest, and create new jobs. However, remember that these changes usually happen gradually, not overnight. So, will the Fed cut interest rates? It's possible, but the timing depends on future inflation and economic data. One announcement from the Fed can influence mortgages, loans, and economic data. One announcement from the Fed can influence mortgages, loans, investments, and the entire economy. That's why investors, homeowners, and everyday Americans pay close attention to every Fed meeting. If you found this video helpful, don't forget to like, subscribe, and turn on notifications for more easy-to-understand finance updates. Thanks for watching, and I'll see you in the next video.